Well, our next guest predicts more all-time highs are coming. I know Carter pointed out some that we still haven't hit yet. Ben Emons is founder and chief investment officer at FedWatch Advisors. Ben, thank you for being here. I mean, I understand that your viewpoint is generally bullish overall. You think we should buy on some weakness. Why?
Well, Courtney, if you take today's retail sales number, there was a clear acceleration happening within the number. And what's encouraging is that the core piece, which is called control group, was revised upwards. So that gets directly into GDP. So it seems that we're coming out of the summer lull and swoon into some sort of acceleration phase, while we're having some weakness in the labor market that is keeping this rate cut probability in check, that we'll likely see the Fed deliver on this rate cut. So you're getting a cocktail here of already an economy coming out of a summer lull with potentially rate cuts following. You can see the scenario that actually getting an acceleration in the fall, which means that will be matched by the stock market. So any kind of pullback that we're getting next week on some trepidation of, will Powell say yes or no rate cut, that has an opportunity, I think, to buy. So it's actually an improved economic environment currently, and I think this is why the stock market will continue to go higher.
You know, it is interesting, sort of the parlor game that is when everyone's trying to guess what the Fed is thinking, what they will say. And we have this very important meeting of Jackson Hole next week where we'll hear from Chair Powell for the first time in some time. And in the interim, you've had market watchers speculate 50 basis points of a rate cut could be on the table. But as I pointed out earlier, the Fed fund futures aren't really seeing that. Maybe it's just wishful thinking. Where do you really think the chair is thinking about? Where, particularly, I guess, with this week's retail sales, PPI, and the other economic data?
Well, he will definitely be more cautious, I think. He has been more cautious in his tone each time that inflation sees a little bit perking up. But there's these other Fed members who really are ringing the alarm bell, like, look, this labor market is weakness, and maybe continue to weaken from here. I think that's where the 50 basis point rate cut could be coming from. I'm actually myself a bit in the camp of Dave Zervos, where they actually do 50 basis points like an insurance. Because if you let this labor market continue to weaken and employment rate starts rising and starts rising faster, then it moves away from you. So what they did last year was for the same reason. They cut by 50. It was a surprise, but they did it because they want to get ahead of the problem. I think there's a possibility this time they do the same. Yet Powell will be, I think, in his tone, in his speech, cautious on that front. But he's not the only one determining the vote. So we'll see how it plays out. But I do think that this 50 basis point cut is a possibility. Let's say that if it isn't in September, then it could be in October.
Ben, do you think the Fed has forgotten about the balance sheet runoff? When you look at what they're letting run off, the MBS is running off at $35 billion per month, and we have treasuries running off down from $25 billion down to $5 billion. Shouldn't they have stopped that runoff? Because MBS does have that lift effect on the 10-year, and mortgage rates are affected by the 10-year or based on the 10-year, and a third of CPI is housing or shelter costs.
That's a fair point, Steve. I mean, it's interesting. They did signal earlier this year they wanted to stop it altogether, but yet have to do this. And, this does add some tightening to the system in itself. Now, this is like a lot, but it is underneath. There's pressure there. So this meeting, too, that comes up will probably be where it gets determined that they want to end the runoff of the balance sheet. Nonetheless, it's something that is with us here, right? It's a continuing tightening of financial conditions, like subtle, but it's underneath. And I think this is where the mortgage market's been struggling for one reason. As you mentioned, it gets determined by the 10-year yield a lot. We know that the 10-year yield, for example, today was up because of retail sales. So there's also the economy that plays a role against this technical background of the balance sheet. I expect the balance sheet, though, to run off the end. So eventually it gets a deviation for MBS, and that should, with all the attention to MBS that people want to buy MBS, probably be a spread tightening between MBS and Treasuries.
Ben, we know at the top you said that you are generally bullish. Can you give us some actionable ideas before we have to let you go? Where should we be looking to buy?
Right. So what's interesting is that since April 8th, the time to buy, what other sectors have outperformed except for tech were like electric equipment and related to AI power sectors. Now, You extrapolate this out to what may happen in this fall as the commitment to invest in the US really gets some attention from the administration to move that forward. I think materials and staples and energy, which have kind of lagged most of the rally, are, I think, an attractive opportunity here. If you believe that there's going to be more investment coming into the US, I think those sectors can outperform.